Hi everyone, a lot of talk lately about something strange happening in silver at the COMEX, and this time the interesting part is not that one number suddenly became gigantic. The interesting part is that the market may have changed direction after getting extremely quiet. So in this video we're going to separate the useful signal from the loud noise, and you are going to walk away understanding what this open interest bounce really means, what it does not mean, and why the physical silver story is still bigger than one daily report. Today is Wednesday, May 6th, New York time. So before we get into the details, comment below and tell me what day and date you are watching from. And if you value this kind of breakdown, support the channel by subscribing and commenting John A.G. Best below. That helps serious silver viewers find the work, and it tells me you want more calm analysis instead of panic headlines. So here is the setup. Silver open interest had been sitting near levels people have not seen for a long time. Then it bounced by a couple thousand contracts and moved back toward just under 100,000 open contracts. Now by itself, that is not a massive number. In fact, that is the point. The number is still low. But when a market gets that quiet, even a small change can start to matter. And to understand why, we need to define the term. Open interest is the number of active futures contracts that remain open. It is not the same thing as volume. It is not the same thing as delivery. It is not automatically bullish, and it is not automatically bearish. It simply tells us how many contracts are still alive at the end of the day. A standard silver futures contract represents 5,000 troy ounces, so a move of even a few thousand contracts can represent a large amount of paper exposure. But exposure is the key word. It is not the same thing as someone driving a truck to a vault and taking bars out. It is a financial claim, a trading position, a hedge, or a speculative bet depending on who holds it. The contract size is defined by the exchange itself. That is why the first mistake is assuming rising open interest means physical silver is disappearing. It might mean new longs are coming in. It might mean shorts are adding pressure. It might mean spread traders are positioning around delivery months. It might mean producers, banks, funds, or commercial desks are hedging. The number tells you that participation changed. It does not tell you the motive. So when people say, okay, open interest bounced, silver is about to explode, slow down. Maybe. But maybe the cleaner takeaway is that traders had stepped away from silver, and now some of them are looking again. That is different. It is less exciting, but it is more useful. Now here is why the timing matters. Silver has been through a major repricing phase, then a hard correction. That kind of move can chase weak hands out of the market. Newer buyers get excited on the way up, then bored or nervous on the pullback. Speculators do the same thing, just with leverage. So when open interest stops falling and begins rising, it can be the first sign that the market is no longer being ignored. But one day is not a trend. One report is not a thesis. One bounce is not a guarantee. That is the line we have to hold. If the next few reports show open interest continuing to build while price holds firm, that would be more meaningful. If open interest rises and price rises with it, then maybe new long money is starting to show up. If open interest rises while price weakens, that could mean shorts are leaning harder into the market. Same number, different message. This is where a lot of silver commentary goes wrong. People grab one piece of data and treat it like a verdict. It is not a verdict. It is a clue. And there is another clue, which is the inventory side. Registered silver and eligible silver have been moving around. In plain English, registered is the metal sitting in an exchange-approved vault that is already lined up for delivery. Eligible is metal that meets the standard and is in the system, but it is not currently marked for delivery in the same way. It can move categories if the owner chooses to change its status. So when registered silver falls by roughly 500,000 ounces and eligible rises by a little over 1 million, that sounds dramatic, but it needs context. The metal did not necessarily vanish. Some of it may have changed category. Net vault stocks can even rise while registered metal falls. That is why you have to look at the whole picture instead of grabbing only the scary piece. Recently available warehouse figures also show that COMEX registered silver remains a large pool in absolute ounces, but it is smaller compared with the size of paper claims that traders watch, which is why every category shift gets attention. Now, does that mean there is no stress? No, I would not say that either. Silver has been in a structural deficit for years. Recent industry estimates still point to another deficit year, with investment demand doing more of the heavy lifting, while some industrial and jewelry demand cools because prices have become expensive. That is an important change. It means the market is not being held up by only one buyer group, and based on recent market updates, coin and bar demand is expected to rise in a meaningful way, especially with Western demand recovering. While industrial demand may soften a bit because manufacturers are trying to use less silver where they can. That is actually one of the most important points. High prices do not just attract buyers. They also force users to adapt. So the silver story is not simple. Industrial demand supports the market. Investment demand supports the market. But higher prices also reduce some demand, encourage recycling, and make manufacturers look for thrifted designs. That is not bearish by itself. It is just how commodity markets breathe. And this is where physical silver enters the conversation. Futures give you price exposure. Funds give you price exposure. Physical silver gives you an object in your hand. That difference sounds basic, but it changes the entire risk profile. With paper silver, you care about liquidity, margin, roll costs, counterparty structure, and timing. With physical silver, you care about premiums, storage, authenticity, and exit strategy. Neither one is magically perfect. Paper is easier to trade. Physical is harder to ignore. The reason physical silver keeps pulling people in is because silver is not only an investment metal. It is also an industrial material. In the United States, official mineral data shows silver being used across physical investment, electronics, coins, photovoltaic applications, jewelry, soldering, and other industrial uses. The same data highlights silver's conductivity, reflectivity, and malleability, which is why the metal keeps showing up in technology instead of just sitting in vaults. That matters because a normal financial asset can be repriced by opinion. Silver can be repriced by opinion and by physical consumption. Solar panels, electronics, power systems, defense applications, medical uses, batteries, sensors, and data infrastructure all compete for real material over time. Nobody needs to believe a slogan for that to matter. It is simply demand. But again, let's be careful. A strong long-term demand story does not mean silver goes up every week. It definitely does not mean every pullback is fake. Silver can have a great backdrop and still punish late buyers. It can be right long-term and still painful short-term. So what do we do with the open interest bounce? We treat it like an early warning light, not a final alarm. If participation keeps rising, that tells us the paper market is coming back to life. If registered stocks keep shrinking while eligible stocks rise, that tells us owners may prefer holding metal in reserve rather than offering it directly. If physical investment demand keeps recovering, that tells us the public side is not dead. If price holds above the recent correction zone, that tells us buyers may be defending a higher floor. But if the next reports reverse, we have to admit it. If open interest drops again, the bounce was just a bounce. If price rolls over, traders were not ready. If vault stocks rebuild in registered form, the delivery panic loses force. That is how you stay honest. Some people will say the whole thing is manipulation by big banks. I understand the suspicion. Silver has a long history of frustration, and the paper market often feels like it controls the physical story. But the alternative explanation is simple. After a sharp move and a sharp correction, traders came back because volatility creates opportunity. That does not require a grand conspiracy. It only requires a market that woke up. So my view is this. The open interest bounce is interesting. The low starting point is interesting. The vault category movement is interesting. The broader deficit backdrop is interesting. But none of it by itself proves a COMEX breaking point. What it does prove is that silver is getting harder to dismiss, and that is a much better story than panic. Panic burns out fast. Repricing can last a lot longer. There is also a positioning angle that gets missed. The weekly trader reports separate commercial users from managed money and other reportable traders, which is useful because silver can look bullish in the headline number, while the internal structure is mixed. A commercial hedge is not the same thing as a fund chasing momentum. A producer locking in price is not the same as a retail trader buying a breakout. So if open interest keeps rising, the next question is not just how much. The next question is who. The regulator publishes those positioning reports for exactly that reason. And this matters even more because silver is emotionally traded. Gold gets treated like the serious older brother. Silver gets treated like the wild one. When gold moves, institutions talk about reserves, real rates, and central banks. When silver moves, everyone starts talking about shortages, squeezes, banks, vaults, solar panels, and collapse scenarios altogether. That mix can create huge attention, but it can also create bad decisions. So I want to slow the whole thing down. A rising open interest number from a very low base is not proof of a squeeze. A falling registered number is not proof of default. A stronger physical investment forecast is not proof that every coin buyer is about to clean out every dealer. But when all of those things line up at the same time, you do not ignore it either. You watch confirmation. You watch whether the next delivery window pulls metal out or simply transfers receipts. You watch whether price rises with fresh participation or whether participation rises because traders are fighting the move. You watch whether premiums at the retail level stay reasonable or start widening. You watch whether industrial demand gets hurt by high prices because that is the quiet pressure valve nobody likes to talk about. And one more thing, do not underestimate recycling. Higher prices wake up sellers too. Old jewelry, old silverware, industrial scrap, and secondary supply start coming back when the number gets high enough. That does not destroy the bull case, but it changes the slope. Markets do not move in straight lines because human behavior does not move in straight lines. So the smartest silver investor is not the loudest one. It is the one who can hold two ideas at once. Silver can be fundamentally tight and still correct. The COMEX can show stress signals and still function. Physical silver can be valuable outside the system and still have premiums that matter. Collectibles can be beautiful and still not be the cheapest way to stack ounces. That is the balance. Now let me shift this into something practical. If you are a stacker, do not let futures data bully you into rushing. Decide whether you want ounces, collectible pieces, or trading exposure. Those are different lanes. A low premium bar is not the same product as a historical silver art coin, and neither one is the same as a futures contract. Same metal, different purpose. That is why collectible silver has its own audience. A military-themed silver coin shaped around the 1911 style pistol, honoring General George S. Patton Jr., is not trying to compete with the cheapest generic round. It is selling craftsmanship, story, packaging, scarcity, and historical emotion. If it is made from 3/9 fine silver and issued as a denominated coin, then part of the appeal is the blend of metal and artwork. A piece like that is for the collector who wants silver to mean something when it sits on a desk or in a display case. The imagery, the battlefield theme, the Patton connection, the old American military feel, all of that creates a different kind of value. Not melt value, collector value. Would I tell someone to choose that over basic bullion? Not automatically. If your goal is maximum ounces, premiums matter. If your goal is display, history, and limited mintage, then premium is part of the product. You just have to know which game you are playing. If you are successful, share your success story in the comments so others can stay motivated. And now I want to hear from you. Do you think this COMEX open interest bounce is the beginning of real momentum, or just a temporary reaction after silver got quiet? And when it comes to physical silver, are you more interested in low premium weight, or do limited historical pieces deserve a place in your stack? So putting this all together, something did happen at the COMEX. The market stirred, paper participation ticked up from depressed levels, vault categories shifted, physical demand is still part of the bigger picture, and silver continues to sit in that unusual place between money, industry, speculation, and collector culture. That does not mean you should panic. It means you should pay attention. If this helped you, subscribe, stay patient, and do not let one daily report make emotional decisions for you. Silver can move quickly, but the people who survive this market are the ones who understand what the data is saying and what it is not saying. And just to be clear, this is for education and market discussion only. I am not telling you what to buy, sell, or hold. Do your own work, understand your own risk, and never let a dramatic silver headline make the decision for you.